Right. Okay, Snehi. In fact, let me welcome on board and let's try and dissect the sector performance further. We've got Abneesh Roy joining in on the show right now from Nuvama Institutional. Abneesh, hi, morning. Great to have you on ET now. Abneesh, just taking a leaf from what Snehi was recapping about the FMCG sector performance. Yes, there's been that volume rebound and staples are regaining momentum. But if I were to just pick up on the staples piece right now, does it seem like this momentum has further headroom and can carry on into the next quarter too?
Yeah, thanks and good morning. Yes, I think the recovery will continue, gradual recovery will continue. In Q3, if you see, paint companies also saw 8% kind of volume growth for the market leader Asian Paint. Our sense is that was after a very weak October month. So you will see that in Q4, we expect Asian Paint to deliver almost 10% volume growth. Yes, the second thing is from a urban and rural continues to grow faster than urban for most companies, and our sense is that will continue. The issue for the FMCG and consumer companies was the urban demand, and urban demand has come back strongly. And Nestle is a very good barometer for that. Our sense is Nestle will continue with strong double-digit sales growth led by volume growth in the next 3 quarters also. We are also seeing that most of the large FMCG companies are going for market share gain. If you see, Asian Paint has clearly highlighted that they will go for market share gain in the next 1 to 2 years. Britannia, the new CEO, clearly laid out that yes, startup culture, acquisition, they'll go for again market share expansion. HUL has also said, for example, the hair care market share is at a all-time high. So we are expecting that large FMCG companies will do M&A, and they will also look at organically expanding market share. Raw material wise, no big concern. And second is the shift from IT and tech portfolio towards other sectors. We are seeing that churn in terms of the stock market. So we'll see that FMCG could also gradually gain because investors will look to shift their sector allocation maybe from IT towards this in the near term. Of course, long term, I think all sectors can do well, but we are expecting that FY27 is looking like a strong year for FMCG given the GST rate cut. Overall inflation is in control for consumer, and we are also seeing that the raw material side, no big problems. So 1 to 2% price hike also we expect for most FMCG company in FY27.
Interesting. Abneesh, there's certain pocket of, firstly, hi, very good morning, this is Harsha. Okay, there are certain pocket of FMCG companies which have done well, where margins are concerned. And then you've got, some others, the likes of an HUL, where margins have actually remained subdued, if I can call it that. What in your opinion is creating this divergence of sorts with regard to where margins is concerned?
Yeah, thanks. Good question. You're absolutely right. HUL, the margins have come off a bit in the past few quarters, but that was a stated strategic objective, right? They said that they will lower their margins by around 100 pips from 23 to 24% to 22 to 23% because they want to go for volume and market share. And my sense is now with ice cream business not there in the base, you will see that they will shift towards more of 22.5 to 23.5 EBITDA margin. Second point is, margin is a function of operating leverage and scale. So as we see 1 to 2% pricing growth and volume growth also recovering for most FMCG, the EBITDA margin also should expand because of that. Yes, advertising spends will go up, which I think is good news for media companies because GST has been a clear driver towards volume growth. Because if you see biscuits and say noodles and many of the food category, the consumption happens at 5 rupee, 10 rupee price point and maybe 20 rupee price point. So their companies are adding the extra grammage in terms of GST. That will lead to the consumption boost because customer doesn't buy 100 gram of biscuit or 50 gram of biscuit. He buys a pack. So if there is one biscuit extra, the consumption boost is real. So I would say that yes, in spite of higher ad spend, my sense is FY27, most companies will look at slight margin expansion at the gross margin. Some companies will choose to plow it back fully towards growth. So high ad spends will happen. but that's not a problem because that will go towards demand creation.
Okay. And Abneesh, I wonder, with regard to demand itself, uh, we've seen predominantly most players in the sector haven't grown particularly in double digit. Is that at all a concern with regard to, despite GST rates coming through, we're not seeing demand really translate?
So yeah, you're right. Partly because last 4 5 years FMCG demand has been weak for the industry. If I see the long-term average for the industry, long-term average is around 4% volume growth for the entire industry FMCG with 1 to 2% pricing. Last 4 5 years, because of one reason or the other, there was urban slowdown, there was competition from D2C. For example, Hindustan Unilever, which is the largest company of the sector, if you see in detergent, they have done amazingly well. The kind of premiumization, kind of volume growth, and margin expansion also they have delivered. I think the same opportunity exists even in beauty and well-being. In beauty, if you see, a lot of D2C startups have come. But the good part is we are seeing that all the listed legacy companies are now really going aggressive in terms of the M&A. Marico, I think, is the gold standard. The way a hair oil company and a edible oil company has completely transformed the portfolio through multiple D2C acquisition, and they have really scaled up well by having the current management stay and then have long-term targets, give a lot of synergy benefit. I think clearly HUL also demonstrated that with Minimalist, Oziva, etc. So that is the other thing we are seeing, that a lot of the D2C companies will eventually get acquired by the legacy company. ITC has also done a lot of acquisition. I would expect Dabur, Imami also to keep doing that in case they have not done that, because that is the clear template which is visible. So yes, that's why both on organic and inorganic, the growth rate should accelerate for most companies. And for example, HUL delivered multi-quarter high volume and sales growth. On the margins, if you see, we are seeing Asian Paint kind of company deliver 9 quarter, 10 quarter high gross margin, EBITDA margin. So some players are already getting there. Some staples companies will get there because it's a function of scale.
Interesting. But tell me, Abneesh, with volume growth now at double digit when it comes to Nestle, and strong growth in premium portfolios at Tata Consumer and Marico, is premiumization structurally driving FMCG growth, or do you think it's more mass demand which is also recovering meaningfully?
Yes, what I will say is the premium end and the lower end seems to be growing faster. There has been some kind of a challenge in the middle end for many companies. In paints, we are seeing that premium is growing okay, lower end is also growing okay, but middle there is some kind of a downtrading in some of the consumption segments. If I see in terms of FMCG staples, broadly companies are seeing 100 bips kind of a premiumization impact on the portfolio. So every year HUL, for example, will add around 100 bips shift from mass towards premium as a portfolio shift. And here again, I would say that premium, etc., the opportunity is higher. So yes, premium will do well because as the hockey stick curve comes for the FMCG, we will see that personal care, foods, functional foods, etc., will see a lot of premium growth. Even in tea, for example, salt, which are again daily consumption, we are seeing that Tata Consumer, Hindustan Unilever in tea, for example, is seeing much faster growth in terms of the premium tea and premium salt wherever the companies have presence. Similarly, in carbonated drinks, we are seeing that a lot of the shift is happening towards sugar-free, etc. So we are seeing health focus being there, premium. Customer wants better benefits. He's willing to pay extra. In biscuits, again, we are seeing exactly same thing. Noodles, again, the premium end of the portfolio is growing much faster. Even for a laggard company like Colgate, premium has grown in double digits. And we expect that FY27, even Colgate should see a recovery on the overall company, and premium should grow faster than the overall volumes for even Colgate.
But two of the biggest ones, that's both Unilever and Nestle, Abneesh, have delivered strong volumes, but there's been a margin contraction. How should an investor be reading into this?
Absolutely, good question. It's a conscious strategy by both companies. If you see Nestle globally and within India, currently this strategic shift is happening that let's go for growth. In Nestle India, for example, the new MD who has come, he comes with the Amazon experience, e-commerce, quick commerce. So we are seeing that Nestle India is extremely aggressive on growth in these channels. So they are investing towards higher growth, higher market share. As I said, HUL has already called out that they want to go for more demand generation. So yes, 50, 100 bips here and there, they're happy to sacrifice. But the whole idea is that we should go for new category creation, go for market share. So that is the whole idea. I don't think investors will be first looking at EBITDA margin, because for any FMCG company, demand volume growth is the most important parameter. And second will be gross margin, what's happening, and EBITDA margin will be a derivative of all this. So I would expect that because raw material side is benign for most FMCG companies, we do see that next 1 year, 1 to 2% pricing hike will come, but companies will look at hiking their advertising spend. Investors will eventually appreciate that. You're right that short term, some investors might feel that the extra volume growth of HUL has that translated towards the EBITDA margin expansion or not. Some investors want both. Some investors are happy with the market share and volume growth. But my sense is eventually for FMCG and consumption, volume and the market share is the most important number. EBITDA margin is a derivative and you can always get it back. But once you lose market share or you are not seeding new growth driver, I think then it's a lost opportunity and becomes very expensive to get that market share back. So I don't think it's a long-term concern, but near-term, yes, some investors may want both margin expansion and volume growth. I think currently Nestle and Hindustan Unilever will look more at augmenting or continuing with the extra growth they are getting. And then eventually they may look at margin expansion. Anyway, raw material side, if you see for Nestle, coffee is correcting, cocoa is correcting for Hindustan Unilever, tea RM is soft, even coffee RM is soft, crude related inputs, no big concern. Whole idea is to increase advertising, promotions, e-commerce, quick commerce, because that is where I think the growth, extra growth will come back.
Okay, and Abneesh, curious to know with regard to some of the cigarette manufacturers and the indirect tax which they are saddled with. You believe that price hikes they are capable of making the price hikes required to offset that kind of cost increase which they will incur as a result of indirect taxes?
Yeah, worst is behind for cigarette stocks. The announcement which came by the union government that was expected, we were expecting a double-digit tax hike, but the quantum was a shocker. But if you see last 7 years, the union government has been fairly cognizant of the illegal market share in cigarettes. And that's why 7 years we had a benign policy by the union government on cigarette taxation, because government wanted to reduce the illegal market share. And that's why if you see last 1 year, ITC and other cigarette players have seen a very strong volume growth. Now going ahead, clearly the pricing power is very high in cigarette companies because one, this is a sin industry, so it's a habit forming industry. Yes, the cigarette companies will take the price hike in 2-3 tranches. One big round has already happened, and more rounds will happen next 2 months because companies will stagger the price hike. They will stagger the portfolio, some portfolio now, some portfolio 2 months later. But eventually what I see is the entire pricing will be eventually passed on to the end customer. Initially, they will look at absorbing some of the taxes because it's a very, very sharp hike. I don't think in the Indian cigarette industry, we have seen this kind of a tax hike and price hike. So need to be a bit gradual there. The good part is the cigarette raw material tobacco is favorable. So we are entering a cigarette RM favorable cycle. Next 1 year, we will see that benefit. So this will help in gradual pass through. rather than an immediate pass-through. Coming to valuation, clearly ITC stock has seen a sharp correction because of this development. Going ahead, FMCG will do well because of the reasons which we mentioned for even ITC. Even the paper business will see the merger benefit with Birla Paper, and agri, based on the tariff, etc. I think that will get driven. So we are positive on ITC from 1 to 2 years perspective. The risk here is bad stake sale that remains a monitorable. But from a cigarette pricing, I think we have high comfort. We don't expect high single-digit volume decline in cigarette. Our sense is it will be in the more 3 to 4% volume decline for FY27. And cigarette EBIT growth, initially there will be compression of margins, but H2 we see the expansion happening because of the favorable raw material and full pass-through of the pricing. So worst is behind, but it will be 1 to 2 years time frame for the investors to take a call on ITC.
Okay, Abneesh, great to get in all that insight from you. Good to be speaking with you as always.
Thank you.